Good morning, everybody, and welcome to the IHRM webinar. Today, we are going to be discussing an interesting topic that's very close to my heart, and that's around the retirement benefits. My name is Rose Sang, and I will be moderating the session today. So please put your questions across on the chat box, and we should be able to respond at the end of the presentation. So in light of COVID-19, pension managers in Kenya project depressed growth in retirees' funds due to the coronavirus pandemic that has negatively impacted the financial markets. We have seen erosion of value of investments at the Nairobi Stock Exchange. Some talk about deferred contributions. Others are talking about the possibility of taking a mortgage against the pension contribution. The question is, are our pension funds safe in light of COVID-19? And what options are available to us with regards to the investments? So to help us unpack this, it is my pleasure to invite my good friend, Simon Wafubwa, who is the Managing Director of Enwealth Financial Services Limited, the fastest growing, most innovative and customer-centric pension administration and consulting services company with an asset portfolio of about $620 million in the last 10 years. He is a member of the Pensions Management Institute of the UK and has worked in senior positions in both local and multinational organizations for over 15 years, giving him a broad and extensive experience in social security financial services consulting. Simon is also a council member of the Association of Retirement Benefits Scheme in Kenya and a part-time lecturer teaching pension trustees certification at the College of Insurance here in Kenya. So karibu sana, Simon, to the IHRM webinar. I know IHRM is not a stranger to you because you have been supporting in various aspects.
Yes.
And so the platform is now yours. We look forward to hearing from you. You'll have about 30 minutes to present, and then we'll forward the questions to you so that then you can address them on behalf of the members. So karibu sana.
Thank you so much, Rose, and grateful for the opportunity to share about the impact of COVID-19 in the sector of retirement benefit schemes. And to the members who have joined, quite an honor and a privilege. I work with Enwealth Financial Services. Enwealth stands for Enabling Wealth Creation for a Better Tomorrow. And our vision is that the customers we serve, we would enable them to have a dignified retirement life, and we do this through innovation. As already you had about 40 employees, and we are in 3 countries, Kenya, Uganda, Mauritius, with a portfolio in Kenya shillings of around 62 billion and 50,000 members, just estimate that we serve. I am doing a rush because there is so much to share in 30 minutes, so you bear with me, and just also for integrity reasons, just to also update the audience that my term ended as a council member with the Retirement Benefits Association. So that's just to let you know. And in Mauritius, we are licensed by the Financial Services Commission. You can check their website, you'll see us there. In Uganda, we are licensed by UBRA, the Uganda Retirement Benefits Authority. And we also have IRA license for insurance brokerage, where we do provide insurance broking services. And in Kenya, we are licensed by the Retirement Benefits Authority. Our core services, just to run us through, is just fund administration. We have online access to statements for our members, and we do consulting and retirement planning training. And I would like to extend a free session for anyone, any HR manager that would like to have free personal financial and retirement planning sessions through our webinar. You can reach out to us, we'll be happy to support. We also do provide corporate trustee services. On the retail end, we have personal pension plan, which is growing very fast. Our retail book is now combined about 3 billion, and income drawdown as an option for annuity, and we also have a medical product for retirees and a diaspora product. We have an umbrella pension product also for SME sector. Now, straight into the concerns that COVID-19 has presented enormous challenges and opportunities that can ably be responded to, whether through sensing. Sensing means we identify those opportunities or risks presented through the COVID-19 and analyzing those risks, measuring in what way are they going to impact us, and then also responding by way of acting. Anytime in life or in any society, we have three categories of people. One, people who watch things happen. Two, people who things happen to. And three, people who cause things happen. And people who cause things happen are those who sense and respond. We have amazing opportunity to be at the center stage of scoping value, depending on how we position ourselves as HR managers or institutions from a strategic perspective. And I think strategic partnership from human capital at this point is extremely important for HR not just to support, but also to sit at the table, at the boardroom, in contributing to the strategic intent of the organization in scoping value from the COVID-19 situation. Obviously, this can only be ably achieved if we align from a scalability perspective that what is HR human capital doing from uh, analyzing and contributing from the infrastructure perspective, skill and culture perspective, and also from the innovation perspective, product and service. A bit of research in 2019, a research we did in partnership with Strathmore University and Institute of Human Resource Management, we noticed that only 1 out of 7 Kenyans are happy when they are told to go home. Your time has come for retirement. The rest would like to keep coming around and check whether, and they will make mention like, we just came to read newspapers. At 10, they will read up to 10 and ask, kwani hakuna chai leo? And even others refuse to leave office. And clearly, when we checked, some of the concerns were that would push most members to fear to go home is unpreparedness, because they are used to waking up at 4, going to work, and they are not quite prepared. So first day on retirement, they are told, go to, you have to stay at home. They haven't formed the social capital at home. The concerns, you wake up, for 30 years, you never used to stay with your wife or husband, so you have become a stranger. You wake up at 5 and but not going to work, you are staying at home. So what do? Even the dogs, to you, they are stranger. They start beating the tail. They are wondering, who is this new person in a homestead? Those are concerns. Medical bills, playing, reduced income. And those are some of the concerns that I'll be talking about. And largely, these statistics are sourced from the RBA. So 3.2 million include NSSF servers, and assets in the industry as of December 2019 would be about just 1.3 trillion, and inclusive of 1.3 trillion is the NSSF contributions. Service providers, we have about 31 administrators, 24 fund managers, and 11 custodians. Custodians licensed by CMA and also RBA. Fund managers also licensed by CMA and RBA, and also the administrators licensed by the Retirement Benefits Authority. And clearly you can see that the sector has continued to grow right from 2001. I mean, amazing growth. And the reasons for this rapid growth is purely because of good governance in pension sector, the legislative framework that is quite robust, compelling employers to put aside contributions in retirement benefit schemes, and those investments accruing on those contributions obviously has had amazing growth impact on this sector. Again, borrowing from the statistic from the retirement benefit sector, the Retirement Benefits Authority, the bulk of these assets are predominantly invested in the government securities, and also we have corporate bonds. We have also guaranteed funds. Guaranteed funds are funds that are invested by insurance sectors. So pension schemes will then have the funds underwritten by insurance companies that have approval from the Insurance Regulatory Authority. And under guaranteed funds, you have a surety of a minimum return, irrespective of the economic environment that the funds are invested in. Of course, then the effects of the COVID-19 in the retirement benefit sector is that this has had direct and indirect impact to both members and employers of retirement benefit schemes. In terms of employers, especially in the hospitality sector and even the manufacturing sector, we've had inability to make contributions to the retirement benefit schemes within the statutory timelines because of cash flow issues. And of course, to the members, when they are asked to either their contracts have come to an end, some companies have had to retrench, then it means then we have to pay out members as they leave. Anxiety because of reduced income is one of also the direct impact to the members. Of course, this in the capital markets, we saw like in Q1, towards end of March, a decline in the stock market, almost 18–20%. It means then that this is capital erosion on the cumulative value of savings in the retirement benefit sector. Some employers have had to respond to this by suspension of contributions. Some have had to reduce salary. Therefore, the applicable rates of contributions would then apply on reduced basic pay, and therefore contributions coming to the pension schemes are reduced. Schemes that had investments in property, now you have to review. Some of those tenants are unable to pay rent. So again, there's negative impact. I already commented on the stock market decline, but however, in April, we saw a little bit of market correction. No worries, because in a big way, pension schemes are long-term investors. Compliance challenges, I'll be commenting on that because employers are not, trustees are not able to physically meet in some occasions to be able to host meetings, but we've now had to adapt to do trustees meetings online. Straight into the perspective of human capital, you notice that organizations have put in place a defined benefit or defined contribution, what we call occupational pension plans. The contractual obligation is arising out of the employment relationship, which has a promise of pension. And to realize that promise, separate legal entities put in place, established through a trust deed and rules, and trustees who are then the legal owners of the trust assets, they hold those trust assets in trust, acting on behalf of the members and the beneficiaries. And of course, guided by the Retirement Benefits Act, where such a trust exists that carries a promise of a pension, then you have to get it registered with the Retirement Benefits Authority. And of course, you also need to have in place a governance framework that require to have service providers, ensuring safety of the member savings. Just to break it a little bit into a very lay language, picture a scenario before we had M-Pesa, how you used to send money home. You look for a trusted neighbor, and that trusted neighbor, you would give him 1,000 and you tell him at Machakos Country Pass, take this money to my relative or my wife or my husband, let's say in Kakamega, I'm using that, not that I come from there. I assure you that I don't come from there, but just to use that. And let's say the bus that is being used is, I don't know which one, maybe Easy Coach. So the person you are sending become a trustee. The person who is sending become a sponsor. I know the meaning of the word sponsor has evolved, especially in Kenya. So we would contain ourselves the meaning in the word, the relevant meaning in Kenya, the RBA Act, not the one you are now thinking, especially. Let's combine ourselves there. So the one giving the 1,000 become the sponsor. The one carrying the money become a trustee. He's carrying the money on behalf. The money doesn't belong to him, but the recipient in the village then become the beneficiary. In a very basic language, that's how trusteeship concept works. That the settler is a sponsor who has given the money. The one carrying the money is a trustee acting on behalf of the members and the beneficiary in the village. And he or she has to exercise a fiduciary responsibility to safeguard the benefit and ensure safe delivery of the benefit as expected. Of course, employment rights are protected by Constitution under the Employment Act, and Section 9 and 10 of the Employment Act, mandatory details of a contract of employment such as place of work, hours, and also provision of particulars of retirement benefits also has to be made provided. And where such changes have to happen, then the employee need to be notified and also consent to. Other major change that I also need to bring to our awareness that you need to note, just to check on my time, is we also had changes, and this is critical, especially HR practitioners, to note that we now have new rates in terms of taxation, and your pension administrators, you need to cross-check that at the point with the effect from April, that in terms of benefits computations, these new rates need to apply so that you don't overtax or undertax the members' benefits. You may want to liaise with your respective pension administrators to cross-check and ensure that these new rates ideally are being applied. And one fundamental one is where members are contributing more than 20,000 per month, corporation tax rate now has reduced from 30 to 25, applicable on the investment income allocatable on what we call the non-exempt or unregistered portion. Other key issues to note in terms of measures by RBA is waiver on penalties in the event of late submission of audited financial statements for schemes whose financial year end was 31st March 2019. The financial year end 31st December 2019, and whose audited financial statements were due 31st March 2020. Levy is now allowed. You can use an estimate or RIO, but also, again, there is some remedies around that. It's a requirement that trustees who serve on trustee boards for pension schemes have to go through the DDPK as a mandatory requirement, but now because of inability to have this meeting physically at College of Insurance, this has been put on hold. For schemes whose fund value is above 5 billion, you are expected to have good governance policy guidelines in place. Again, you are now allowed to explain in writing to RBA on what is the remedial measures you are to put in place. If you can't have an annual general meeting physically, you possibly can postpone, but the options you have is Zoom meetings or other online appropriate technology platforms. You can have this happening. Where trustees' terms have lapsed and you can't hold an election, you can write to RBA and explain yourself, and you'll be guided accordingly on the options. For employers who are unable to remit contributions, the following options would apply. One is you can suspend contributions, but you will need to get approval from the regulator. Two is that you can vary contribution rates. Again, you will have to seek approval from the regulator. Of course, seeking this approval from the regulator, you'll have to do some requisite paperwork, right from the communication to staff, board resolutions, and also trustee and sponsor resolutions, and certain documentations that will be guided by your service providers. You can also temporarily suspend or either or both of employer and employee contributions for specific periods subject to consensus of members, evidenced by member signatures or joint affidavit between sponsor and the trustees. Or you can as well discontinue contributions leading to winding up of the scheme. Where this is the case, then there are statutory framework provided within the RBA regulations in terms of winding up of schemes. Other areas of impact is on investments. Trustees have to review the investment policy in support with the fund managers to check how realistic they are as it relates to performance benchmarks. For guaranteed funds, sometimes you find the approved issuer would say the minimum guarantee is 5 years, 5%. But when it comes to circumstances like this, you would want to cross-check the finer details that doesn't give room to say, look, because of force majeure or acts of God, that minimum guarantee rate of 5% would no longer apply. Might help to cross-check those deposit administration policy terms that you have in place where your schemes investments are with the insurance companies. For schemes that have defined benefit scheme where the benefits are determined by length of service, final pensionable salary, and the pension accrual factor, perhaps cross-check with the advice of your actuary on the accrual rate together with the assumptions applicable in alignment with the funding rates to ensure financial solvency and sustainability of the pension schemes. You may also cross-check the going concern because you are deriving funding from the sponsor as to whether they would be able to continue funding sustainably the scheme. In terms of member operations, where members are to leave, I think there is need to continue to educate the members and also talk to them and sensitize them so that they are ably educated on benefit access options. And if they are leaving, I think update nomination of beneficiary forms. A lot of service providers, their digital platforms are now online for access of benefits. Risk management might help to update the governance risk management register for pension schemes that are realistic and aligned to COVID-19. I want to do this quickly. Housing is another change that has come in. Section 38 of the Retirement Benefits Act has been amended to propose that members of pension scheme may use in part up to 40% of their savings for mortgage for housing. And I would want just to guide that the act has been put in place, but the regulator is working on regulations to implement the act. Views have been sought by the market, by the regulator from the industry, and they are now being analyzed by the regulator for submission to Treasury, and hopefully this will then go to Parliament. The limit of amount that can be accessed is up 40% of the members' accumulated benefit, subject to a maximum of 7 million. And facility can only be used once. Facilities are available before retirement, and schemes to set minimum requirements and procedures for application and to respond to members who apply within 60 days. And define the institutions to provide this housing that members can purchase, a financial institution, insurance company schemes, tenant purchase schemes, circles, and projects approved by the Ministry of Housing. And this is not where we are. Ideally, it's not unusual in Singapore, just to look at peer review. We have pension schemes, a pension account that will have for income replacement and also home ownership and also medical. And the same also in South Africa, Also, you could borrow from the same and also in the UK. And so it's not unusual that the proposal now is that not just only pension contributions plus income that gives you a benefit for pension, but also then there can be an allowance for home ownership, because home ownership would go hand in hand with retirement. I think when you have a home and you have a pension, and then you also have a medical cover, should go, and then you also have good knowledge on retirement planning. I think it should go hand in hand to secure your well-being in retirement. Our view is that this needs to be well balanced, otherwise we might have a situation where members retire with a house but no money. And so I just want to wrap up with, it's important that whereas we are having this policy framework shifts in the market, you still have a personal responsibility as a member or as HR to guide your members to know themselves from a financial planning perspective. That with adequate knowledge, financial planning, they can have capital accumulation, which is phase one. This is before retirement, that they build up income adequacy such that when they come to retirement, this is decumulation phase, they have enough savings that they can fall back. You don't want a situation where when one retires, they have nothing to fall back. And this is a chance that they can use if we give them enough information. And that would entail that they build their income ability, because resources will always flow to where capacity is. And also they need to manage themselves, because financial freedom is only 20% knowledge and 80% behavior. And also ability to risk manage their savings and their investments. This can only be ably done if they do their personal SWOT analysis from a five-pillar perspective: social capital, spiritual capital, financial capital, and risk management. With this, then they can set goals that can be able to answer to their financial priorities at each stage of life. I think with that, in the interest of time, I just had 30 minutes. I would like to spend more time on question and answers. Thank you, and back to you, Rose.
Thank you, Simon, for that. Indeed, you said 80% knowledge, 20% behavior. So one of the questions that's coming through is, we are seeing market swings. And as we read a lot about retirement benefits, we are finding that the fund managers are taking a lot of caution in terms of where they're investing. So looking at government securities and so on. So are our funds safe given the market swings that are going on at the moment?
So predominantly, I think the bulk of our funds are invested through government securities. I think for segregated funds, funds that are held by custodians and fund managers and not directly invested by insurance companies, you would have about 60% in government securities, and just about an average of about 20%, 25% in the stock market. So even if we have a decline in the stock market, you still have the bulk of the assets that are in what we call the fixed income securities that you are relatively assured of periodic income from the interest rates, from the interest income that would accrue on those investments. What I have also seen a number of fund managers doing is that because the stock market is relatively cheap, like Warren Buffett would say, be greedy when everyone else is shy, and be shy when everyone else is greedy. So a number of fund managers are using this opportunity actually to buy cheap stocks with the hope that at the point when they start to rally up, we are going to then benefit from capital appreciation from the stock market, at the same time from the dividend income that would accrue from that. Even having said that, it's fair enough to say that is quite an okay to play safety and some level of precaution in the way then the assets, the portfolio allocation of the various assets are. But also, finally, we shouldn't panic for short-term volatility because the nature of pension schemes is relatively long-term. That even where we have a decline in the short term, I think we should play patience and not react to panic to short-term volatilities.
Yeah,
But
thank you for that.
I just want to also precaution that trustees should work closely with the fund managers, that at this point when members are leaving and assets have to be liquidated to avail cash, carefully choose assets that should not, fund managers should assets that crystallize losses. For example, if a certain share, the value at the close of year was maybe 1,000, but because of the COVID-19, there's a decline to 500. The fund manager could look at alternative asset class that could be liquidated so that you don't sell at a loss to avail cash for members who are leaving to be paid from the pension scheme.
All right, thank you for that. Members asking about clarity on the housing. So walk us through what that looks like. So right now we hear that the prices of housing are going down. I've probably been working for the last 20 years. What does that mean, and what's the process, and what would then that mean for me when I retire with regards to the funds that I have within the retirement benefits fund?
So allow me just to share a slide. I hope it will be able to help. I've attempted to do some. So first is that Enwealth position on this is that it's a welcome move on this, because home ownership, there is absolutely no need why you should use your saving for retirement at retirement to buy a house at age 60 when you have very few years to time T, and you know time T. And then also you are only 2. And then at that point, you are doing a house for 12 bedroom, and your children have left. So it doesn't make sense. Why can't we have mechanisms where you can have a house at age 30 or 40, a little bit enjoy the house? So you're asking, how does it look like? The understanding is that probably right now, mortgage rates may be around 12%. If you are to take a house of low-cost housing of 3 million, and you move your 40% from your house, your pension saving at age 30 to retire at retirement, normal retirement age, say at age 60, let's take that, you probably would repay your mortgage at 26,000 per month. And if you are earning 100,000 per month, you probably are paying rent of 30,000 per month. Can you imagine if you had a low-cost housing of 3 million, 2 bedroom perhaps, and you secure the balance at 2.5 million, and if you reduce this 12 million to, because of maybe the low-cost housing through Kenya mortgage refinancing, and at secured a repayment plan for some arrangement at 7%, this then comes to 17,000 repayment per month. Even without that 7% cost of mortgage, 26,000 per month is within your rent repayment. So you can easily convert your rent into mortgage repayment, but you are going to retire with a house and a pension. And when we worked out your income replacement ratio with a house, you probably would still be around 35%. if at all you don't access your pension. However, I think we are worried that if this is not properly well managed within the legislative framework, we might have a situation where members then retire with the house, but without adequacy of income replacement. And so a lot of more education to members to increase their additional savings through the additional voluntary contributions so that they not only retire with the house, but also with adequate income, investment income to cushion their well-being in the house. So I hope that this is a practical example that you can. If you are age 40, hopefully you have a pension saving of around 5 million, and you move your 20% perhaps as a deposit to a mortgage of 5 million, and you don't want your landlord to come and remove the door and the roof because you haven't paid. So you have 1 million unlocked, and you have a repayment of around 3.9 for a period of 20 years. You will have a mortgage repayment at 12%, estimate of around 43. Anyone earning about 200,000 per month, you probably are paying rent of around 60,000. And so you can see that you can easily convert your rent into mortgage repayment. And again, then you can retire with a house and with a pension. Okay, yes, Ross. I also want just to precaution that the regulations are draft and they have to be approved. So this is just a case study. It's not a real case scenario will be based on the actual regulations. So I give that disclaimer. So don't take this as real. This is just an example. The actual will be when the regulations have been gazetted. So for now, we don't know how those regulations will come out. But I just have taken a hypothetical example. Why I have also taken this in a staggered perspective is that when you are near retirement, I think you need more pension than a house. This is my view. And it's fair enough to balance that. And perhaps it may help to reduce the percentage transfer. And also because when you're near retirement, we hope then that you have enough savings. So even 10% would give you a lot more deposit compared to someone who is young. And the other reason I say that is when you are young, you are potential to build up your saving, you have the benefit of time compared to someone who is closer to retirement. Back to you, Ross.
Thank you, Simon, very insightful. I know I've had the benefit to sit with you and go through some of the numbers. Perhaps walk us through what savings plan, perhaps a 30, a 40, a 50-year-old should be looking at now in light of COVID-19. We have, as you said, depressed markets, so there might not be a lot of opportunities for us to invest now. So what should we be looking out for from an investment perspective?
Just maybe as you get another question, allow me, I am opening just to be able to share. Could you be reading for me another question as I open to project another slide that should be able to help you on that? So yeah. I think I'm already there, so I could just share with you. First is that before you even talk of a saving plan, Rose, it's extremely important to have to answer to the question, why are you saving? And that's a question of your vision. If you don't have a vision, you won't have provision. Because resources go to where a vision is. And while you do that, it's helpful to, and fair enough to, develop what I call a personal wealth creation strategic plan for your family. Whether you are a husband or a wife, and within that space of a personal wealth creation strategic plan, then also agree on the kind of foundational value system that you are willing to earn wealth and keep it. So even as you do that in this COVID-19 situation, have a budget, and that budget, generally speaking, 10% of your income, you could put it in what we call an emergency fund. This emergency fund will come in handy to safeguard you from borrowing expensively from the Shylocks. Because, and sometimes I get extremely disturbed by some men where the wife is 2 days to delivery, and then he calls you and tells you, I have an emergency. And you ask yourself, kwani, for 9 months, haukujua? You woke up every day not noticing anything. So this 10% helps other than the medical cover for emergency. And then of course, George S. Carlson, the richest man in Babylon, he talks about those who create sustainable financial freedom. They have a discipline of 10% into saving and investment. 10% you give, and 10% you continue to develop your career, because World Economic Forum has proposed, has in their research, their report in January indicate that by 2030, almost 40% of the skills that we have will fall off. So are you going to still earn revenue through the current skill that you have? And that's extremely important. Picture yourself as a mobile phone. A mobile phone could do only as little 20 years ago, but right now, because of upgrade, a mobile phone can do so much because of upgrade. So if you are to position yourself as a mobile phone, if you remain the same as 20 years ago, you risk being used on a please call me basis, like Sagem, because you can, on the village. But if you are an iPhone, you can send money, and even look at the way you treat an iPhone or the modern phone. You even have cover, you even have insurance cover. And if you are lost, we'll look for you. But if you are a Sagem, we can't look for you, because the cost to look for you is more than your value. So you have to upgrade yourself. And then 10%, please enjoy life. Life is not a rehearsal. I say amen wherever you are. Life is not a rehearsal. 10% pigia mwili yako pole. Tembea tembea, kula mzuri, enda Kempiski ikifunguliwa, or order those nice things. When you eat, when you benefit from your sweat, according to Daniel Coleman, there is a science between motivation and reward. That those people who have the discipline to self-reward themselves consistently, they have an inner drive to achieve greater goals compared to people who keep on just kujifinyilia, and they don't want to self-reward themselves. And then 50% of your budget necessities, food, shelter, and rent. Now, how can your saving, your asset allocation look like? Prioritize it age-wise. Equities, if you are closer to retirement, please, and this is just a general, it could vary. Don't allow your blood pressure to oscillate with the stock market movement. At age 60, tone down on equities. At that age, you may not have resilience in your physiological abilities to withstand some of these things that we are seeing. But when you are at early stage, you have the advantage of time, that even though the markets can be depressed, they will still recover, and you can ideally play long-term value creation on your savings. That's just a general spread. And then finally, I want to comment on property. We have the tendency, when we did our research with Strathmore and IHRM, we noted that 90% of all our savings is in property. Mutu ni ploti. But when you check the actual return on these savings, it is very not quite pleasant, especially now. Let me give you an example. If you have an apartment in Nyayo Estate, 3-bedroom, the value could be around 10 million. Rent is 30,000 per month. The actual return maybe annual is around 360, ROI is 3.6%. And if you put in capital appreciation, you can just estimate it to 7%. You discount with tenancy default, and you know in Nyayo you can't remove the roof and the door. So those are some of the risks. But if you took the same 10 million and invested in fixed income government bonds, you probably will have a return of around 12% and with no pressure, and is liquid, you can trade. So it may help to diversify your personal wealth creation so that you don't have what we call concentration risk. Back to you, Ross.
Okay, thank you, Simon. I can see time is flying past. So the last question is around, I'm now looking for a financial advisor. What should I look out for from a competency perspective? Because we have quite a few out there and we want to ensure safety of the funds that we have.
So pillar number one is trust, and trust is 3, competency. And then 2, credibility. Are they looking for you because of your money, or they have genuine interest to help you do very well? And also cross-check on their character. Because if their character is wanting, you'll be a casualty. And according to Speed of Trust, Steve Covey, when trust is high, speed of achieving your goals is high, you get it cheaply. And so trust is a key component in that. And I don't think that is fair enough of you to do that quick. I mean, at first interface, you are signing up. I would imagine, I think, take a little bit of time to work out, to cross-check on what are they founded on here. Because if they are deeply rooted in terms of integrity, you probably can trust that you'll get your fruits, your financial fruits. Also check on their capability, and also check on their licensing with the IRA or with the RBA or with the CMA. And also check on their track record. And their track record will be around the competencies, the capabilities. It will be helpful to cross-check on that. Back to you, Rose.
Thank you for that. Any final thoughts around, retirement, savings, things we need to look out for before then we can be able to hand it to the chairman to give us a few closing remarks as well?
So sit back and ask yourself, what lessons are you learning from this COVID-19 situation? If COVID-19 situation happened another time, God forbid, are you likely to survive financially? Do you again want to learn through experience, which is extremely expensive? I think we have fantastic opportunity to redefine our future, our financial wellness into the future through the lessons that we have learned from the COVID-19. So I would like to recommend that sanitize your financial expenditure and lock down wasteful expenditure, and then unlock down your saving ability. So let me repeat, sanitize your wasteful financial expenditure, and then lock down your wasteful, and then unlock your saving ability. And in the pension sector, gladly now, that if you increase your saving with the proposed new regulations, you will not only be saving for your retirement, you'll be saving for medical, you'll also be saving to push up your ability to be a home owner, so that you don't have to pay rent And then also you save on tax, that the pension contribution that come in the pension saving, they are tax exempt up to a maximum of 20,000 per month. Institutions like Enwealth Financial Services are more than happy to support you through our personal pension plan, or you are, as an organization, we can help you answer to that need efficiently, effectively. I also want to comment on this. I am more than happy to share with you free templates if you are HR manager, your organization is struggling or considering to review contribution rates and you don't know how. We have template documentations that have been approved and reviewed by our legal department. We can share that freely. You just modify resolutions by the sponsor employer and the various options that you can consider. Shoot us an email. I think I can give you my email just quickly. Shoot us an email, we'll be happy to give you just a minute. Shoot us an email on the screen. I can just, 1 second, our contacts. You can see our contacts on the screen. info@enwealth.co.ke. We'll be happy to share with you those free documents. We'll share with you free member communication, sample member communication on how to review contribution, also sample trustee resolution, also sponsor resolution, and a sample letter that you'd want to seek approval from the RBA. If you drop us an email on that, we'll be happy to share with you, and our legal department can also engage with you on the same. Thank you.
Thank you, Simon, for the wonderful presentation, as well as the treat around the templates. Very, very much appreciated, and I'm sure members will reach out to you. So at this juncture, allow me to invite our chairman, Mr. Joseph Onyango, to give some remarks and to say hello to the members as well. Karibu sana, Chairman.
Good morning, Rose. Good morning, Simon, and good morning, members.
Good morning, Chairman, and glad to have you.
Yeah, nice to see you too. It's been a while I was listening in, although I checked in a little bit late.
Chair, I have the mask. I'm keeping safe.
Very good, very good.
Yeah, thank you.
Yeah, yes. Yeah, I think it was a very good choice that we had you and telling our HR members about how actually we should behave in terms of investment. This is really, really key and has come at the right time. I know this was a request. There were a lot of requests from the membership on just that kind of guidance and how we can have practical solutions to the issues that we are faced with during this COVID. And therefore mine is very brief. It's just to show appreciation on the time you've taken with us. And of course, the contribution and the linkages that we are having. One of the things that I had a meeting yesterday with all the branch leaders around the country, and something interesting really came up as a result of this COVID investment and plans. And two things, we arrived at two things. Number one, we really have to fast track the issues of benevolent fund, which we are working with Enwealth. And number two, also on special issues of the
Chair, I think unmute yourself, sorry. Yes.
They'll be out to through the branch chairpersons on the various interests and for them to give contribution on their financial well-being. And I think this is very key. And therefore, I don't have much to say today, but just to thank you very much, Rose, and to thank HRM Secretariat for this particular one. Just as a reminder, again, we are having probably this is the last free webinar, and we are re-strategizing for purposes of the business continuity programs for HRM, and we'll be most likely again maybe calling upon you on the various areas and also to assist us on these new schemes I'm with, luckily, been visited by Dr. Julius Kipngetich, and he had talked to us before, and we were just talking about now living with COVID. And we are saying now going forward, protocols have changed, things have changed, and now people have to really reflect and look forward to what we now call the new normal. Simon, thank you very much. My biggest appreciation. Rose?
Thank you.
Thank you, Chairman, and do Salomia Dr. Kipngetich on our behalf.
Me too. Dr. Kipngetich, yeah.
Okay.
Thank you. Thank you.
As you can see, you're keeping distance.
That is 2 kilometers.
Yeah.
Okay.
Police can now arrest you for not having a mask, so he might have taken himself to be arrested.
Okay.
Okay.
So,
Thank you very much.
Thank you.
Members, let's go sanitize our wasteful financial expenditures. So see you next week as we engage other facilitators on our next webinar. So keep safe and God bless. Kwaheri.
Thank you.
Bye.
Appreciate it. Bye.